Hello, Business 226. We are in week 6 already. We're going to talk about chapters 10 and 11 today. Keep going. You guys are almost there. Just a few chapters left. You guys are doing great. Remember, if you have questions, get a hold of me early and often. Don't wait until Sunday afternoon to get a hold of me for something to do Sunday night. I might not be able to help you. Get a hold of me early in the week. I'll help you out as best I can. So chapter 10, quick overview, sources of capital, component cost, adjusting for flotation cost, weighted average cost of capital, and adjusting for risk. How we use this stuff in the real world. How we get capital. Capital is money. We use the money to buy new things for the business. There's different ways we can get that money. We can get it through debt, owing people money, preferred stock, people invest in us and we pay them a dividend, and then common equity, that's just stocks, selling stocks or the money we make through retained earnings. So we're going to know how much it's going to cost us to borrow money one of those different ways. We can calculate the weighted average cost of capital. That is the average of each of those different areas. That's how much it would cost us for debt, the average of debt, for stock and common equity. That's a long looking formula. It's okay, we're going to go through it. Should our analysis focus on before tax or after tax? Stockholders focus on after tax because they want to know how much money they're going to have after they pay Uncle Sam. So we use after tax costs. Should our analysis focus on historical cost or new marginal costs? Historical cost, we don't really care about. We care about new marginal cost. The only reason we would care about historical costs is if we're trying to replace old debt with new debt. How are the weights determined? Use the accounting numbers or market value. Use actual numbers or target capital structure. It's whatever is correct for your business. So here, remember, we have there are um, solutions. There are PDFs in each of the modules with examples of what we're going to work through. Right now, we're working on chapter 10's example. So Coleman Technologies, firm calculating cost of capital for major expansion. We have a tax rate of 25%. We have a 15-year, 12% semi-annual payment non-callable bond that we're going to sell for $1,153.72. 10% $100 par value quarterly dividend perpetual preferred stock that would sell for 110, common stock for 50, and then a few more details below. So here it is summarized. Um, Number of shares not given in problem, so actual calculations cannot be done. This analysis is meant for illustration. Typically, the book value capital structure will show a higher percentage of debt because of typical firms market to book ratio is greater than 1. So component cost of debt. RD is the marginal cost of debt. Capital, the yield to maturity on outstanding long-term debt, is often referred to as a measure of RD. So here's our inputs. Remember, it was a 1,153, 60 months, semi-annual at 30. So we figure that out. The annual rate is 10%. Interest is tax deductible, so the actual cost is 7.5. Remember, the flotation costs are small, so we're going to ignore those. So the cost of that debt was 7.5%. Component cost of preferred. RP is the marginal cost of preferred stock, which is the return investors require on the preferred stock. Preferred dividends are non-taxable, so no tax adjustments are made. So here we can see that it's 9%. So we have debt at 7.5, preferred stock at 9%. Is preferred stock more or less risky to investors than debt? It's more risky. The company is not required to pay dividends. That's why they have a higher interest rate. And remember, a few weeks ago, we talked about the order of what happens when a company goes into bankruptcy. Debt was near the top, where preferred stocks were after we paid a whole bunch of people. So it's riskier. Um, Firms do try to pay preferred dividends, especially before common dividends. And if, depending on the type of preferred stock you have, preferred stockholders may gain control of the firm. A lot of times, the yield will be lower that's paid out because the corporations will own a lot of the preferred stock. Cost of equity. Selling stock, getting new owners. This is going to be a little bit higher than bonds and preferred stock. Why is there a cost for retained earnings? Because earnings can be reinvested or paid out as dividends. Investors could buy other securities to earn a return. If earnings are returned back to the company, the investors are going to expect a return on their money. Um, that's the goal, is to keep that stock price going up. So if we reinvest the earnings, we want more and more money. Um, Here's a couple of formulas we're going to go through real quick to figure out the cost of equity slash stocks. Capital asset pricing model. So RF is 7%, RP is 6%, and the first beta is 1.2. We go through and figure that out, and we get 14.2%. That's one cost of retained earnings slash common equity. We're going to do a couple. Remember the direct cash flow approach? This big old formula, we get down to 13.8%. So we have one that's saying cost 14.2, another one saying 13.8. Can the direct cash flow methodology be applied if growth is not constant? Yes, you can, but you try to do it in like 5 to 10 year increments. It gets complicated in a hurry. So here we're going to find RS using the bond yield plus risk premium approach. RD is 10, risk premium is 14. This method produces a ballpark estimate of RS and can serve as a useful check. So we have our 10 plus our 4 gives us our 14%. And when we compare them all, hey, it falls in line. This is good job with math and estimation. So we know that bonds are 7.5 because they get paid first. Preferred is 9%. And then common equity, stocks, retained earnings is 14%. If we issue new stocks, there might be flotation cost. And then issuing new common stock may send a negative signal to capital markets, which can depress the stock price. If new common stock issues includes a flotation cost of 15% of the proceeds, what is it? 15.4. What is the firm's weighted average cost of capital ignoring flotation costs? So we go through and remember we did this before where we just average out the cost of each of those, and the weighted average cost of capital is 11.6%. What factors influence a company's composite weighted average cost of capital? Market conditions, interest rate and tax rates, and then there's factors that the firm can control. The capital structure, dividend policy, the firm's investment policy. Firms with riskier projects generally have a higher weighted average cost of capital. Should the company use the composite weighted average cost of capital as the hurdle for each of those projects? No. The composite weighted average cost of capital reflects the risk of an average project undertaken by the firm. The weighted average cost of capital only represents the hurdle rate for a typical project with average risk. So what does that mean? We can borrow money on average around 11-12%. So if we're going to take on a new project, we need to make at least 12%. That way, the cost of our capital is covered. Now, that's going to be different from time to time, right? Like, what if we're a more mature company and we're using only retained earnings to pay for new projects? We would expect to get a higher return than that 14% to 15%. What if we're borrowing all of our funds in the bond market? Well, then the project only needs to have what, a 10% return to beat out that 7.5%. But we always want to make sure that we're getting a higher return than what we're borrowing the money for. Different projects are going to have different risks. The project's weighted average cost of capital should be adjusted to reflect the project's risk. We talked about this earlier. The riskier the project, the more we should expect a return. That goes back to the different investments, right? A bond has a lower risk. A T-bill has the lowest risk, so we get the least return on that money. Whereas a junk stock, we're going to expect a ton of return on that. Or a company that's had a rough patch, their bond is going to be much higher. If you have a low FICO score and you want to go borrow money for a car, you're going to pay a higher interest rate because it's more risky. So here we can see a graph showing our rates of returns weighted average cost of capital, and then we have this is our composite weighted average cost of capital, and we have our different projects. So if this risk is really low and it's above the 7.5%, it's a good project. We should do it. Whereas if there's a project that's a higher risk, we need to make sure that it's getting over this higher rate of return. Chapter 10 was easy. That was a good chapter to get going on this week. Next chapter we're going to talk about is chapter 11, where we kind of apply a little bit more of this stuff to what we've learned already.